to this video where I'll share how to earn up to 3.20% on your savings using fixed deposits. You'll also get insider tips that banks don't want you to know about, and a special strategy that could boost your returns by an extra 0.5%. Let's dive in. Hey friends, welcome back to the Investing Iguana. I'm Iggy, your host and creator. If you're new here, I've been analyzing Singapore's financial markets for over 7 years. Our channel has gained recognition, recently ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 700,000 reads and 50,000 likes. The fixed deposit landscape in 2024. First off, did you know that Singaporeans have a whopping $400 billion sitting in bank deposits? That's a staggering amount. However, here's the thing. Most people are earning less than 0.5% interest on their savings. Yes, you heard that right. Less than 0.5%. That's like keeping your money in a sleepy savings account, earning almost nothing. We can do better than that. Now let's talk about the current fixed deposit market. DBS is currently leading the pack with a 12-month rate of 3.20%. Sounds good, right? But my friends, there's a catch. This rate only applies to deposits between $1,000 and $19,999. And here's the kicker. For amounts above $20,000, the rate drops to a mere 0.05%. That's a huge difference. This unusual structure tells us something important about bank strategies. You see, banks are trying to attract smaller depositors while discouraging larger deposits. Why? Well, my theory is that they're trying to manage their liquidity and minimize their interest expenses. But that's a topic for another day. The hidden champions. My friends, let's talk about the hidden champions in the fixed deposit market. You know, those banks that fly under the radar but offer some amazing deals. And today, I want to shine the spotlight on the Bank of China. Now, I know what you're thinking. Bank of China isn't exactly a household name in Singapore. But hear me out. They've emerged as a dark horse in the short-term deposit space, offering a whopping 3.00% for 3-month deposits with just a $500 minimum. That's right, folks. You can earn a higher interest rate for a shorter period with a relatively small amount. But here's the thing. This rate is even more impressive when you compare it to some of the larger banks. I mean, some of the big boys are offering lower rates for 6-month deposits. That's like getting a better deal for less commitment. And who doesn't love that? Now, I know some of you might be thinking, Iggy, what's the catch? Well, my friends, I've done my research, and it seems like Bank of China is trying to attract more customers and increase their deposit base. And that's good news for us. We get to benefit from their competitive rates. But don't just take my word for it. Let's look at some statistics. According to the Monetary Authority of Singapore, MS, the average 3-month deposit rate in Singapore is around 1.5%. So Bank of China's 3.0% offer is a whopping 1.5% higher than the average. That's like earning an extra $150 on a $10,000 deposit. And here's another interesting fact. Bank of China has been expanding its operations in Singapore with plans to increase its branch network and digital banking capabilities. That means more convenience and accessibility for us customers. Understanding bank strategies. You know, understanding bank strategies is like being a detective, and I love it. So, let's dive deeper into the world of banking and uncover some secrets. When a bank offers high fixed deposit rates, it's like they're putting up a big sign saying, hey, we need your money. But why would they do that? Well, my friends, it usually means one of two things. Either they need to meet regulatory requirements for their loan-to-deposit ratio, or they're planning to expand their lending business. Let me break it down for you. Banks have to follow rules set by the Monetary Authority of Singapore, MAS, and one of those rules is the loan-to-deposit ratio. This means they need to have a certain amount of deposits to support their lending activities. So, if a bank wants to lend more money, they need to attract more depositors. And what's the best way to do that? Offer higher interest rates, of course. On the other hand, if a bank is planning to expand its lending business, it needs more funds to support that growth. And where do they get those funds? From you and me, the depositors. By offering higher rates, they're incentivizing us to put our money with them, which they can then use to fund their lending activities. Risk versus return analysis. My friends, let's talk about risk versus return analysis. We've been discussing fixed deposit rates, but it's essential to consider the bigger picture. So, let's put these rates into perspective. As you know, the current inflation rate in Singapore is 4.1%. That means even the best fixed deposit rate of 3.20% results in a negative real return. Yes, you heard that right. Negative. But before you start thinking fixed deposits are a bad choice, hear me out. Here's the thing. Fixed deposits come with SDIC protection up to $75,000 per bank. That's right, my friends. Your money is insured up to $75,000. This makes fixed deposits significantly safer than many alternatives. I mean, think about it. If you put your money in a fixed deposit, you know exactly how much you'll get back, plus some interest. And if the bank fails, you're protected up to $75,000. Now let's compare this to other options. Cash management accounts like Mumu Cash Plus, for example, offer 3.1%, which sounds good, right? But here's the catch. They don't have SDIC protection. That means if something goes wrong, your money is at risk. And let's be real, my friends. We all know that risk and return go hand in hand. If you're taking on more risk, you expect a higher return. But with fixed deposits, you get a relatively safe option with a guaranteed return. And did you know that SDIC protection is backed by the Singapore government? That's right, my friends. Your money is protected by the government. So, when you consider the risk versus return analysis, fixed deposits start to look pretty attractive. Now, I know some of you might be thinking, but Iggy, what about other options like stocks or bonds? Well, my friends, those are great questions. We'll explore those options in future videos. But for now, let's focus on fixed deposits. Alternative investment comparison. My friends, let's dive into a fascinating comparison. We're going to explore how fixed deposits stack up against other low-risk investment options. I know some of you might be thinking, Iggy, I want to play it safe, but I still want some returns. So, let's examine the alternatives. First off, we have Singapore T-bills with a 6-month tenure, offering a return of 3.04%. That's a relatively safe option, backed by the Singapore government. Then, we have Singapore savings bonds with a 1-year tenure, offering 2.59%. Again, a low-risk option with a fixed return. Now let's talk about high-yield savings accounts. Some banks offer up to 4.0% interest, but here's the catch. There are usually conditions attached, like minimum balances or specific spending requirements. Still, it's an attractive option for those who want easy access to their money while earning some interest. Last but not least, we have fixed deposits with a 12-month tenure, offering 3.20%. As we discussed earlier, fixed deposits come with SDIC protection up to $75,000 per bank, making them a relatively safe option. So, how do these options compare? Well, my friends, it's essential to consider your personal financial goals and risk tolerance. If you're looking for a super low-risk option, T-bills or savings bonds might be the way to go. But if you're willing to take on a bit more risk, fixed deposits or high-yield savings accounts could offer better returns. The SMART strategy. Let's talk about the SMART strategy for maximizing your returns while maintaining safety. I'm excited to share with you my triple stack method. First tier, emergency fund and high-yield savings account. You know, my friends, having an easily accessible emergency fund is crucial. I recommend keeping 3 to 6 months worth of expenses in a high-yield savings account. This way, you'll earn some interest while still having quick access to your money when needed. Plus, with high-yield savings accounts, you can earn up to 4% interest, which is pretty attractive. Second tier, 3-month fixed deposits for short-term goals. Now, let's talk about short-term goals, like saving for a vacation or a down payment on a house. For these goals, I recommend using 3-month fixed deposits. You'll earn a higher interest rate than a traditional savings account, and you can lock in your money for a short period. Plus, with 3-month fixed deposits, you can earn around 3% interest, which is a great return for a low-risk investment. Third tier, combining 12-month fixed deposits with T-bills. Now, for the third tier, I recommend combining 12-month fixed deposits with T-bills. This is where things get really interesting. By combining these two investments, you can earn even better yields while still maintaining a relatively low risk. For example, you could put half of your money in a 12-month fixed deposit earning 3.2% interest and the other half in T-bills earning 3.04% interest. That way, you'll earn an average interest rate of 3.12%. The beauty of the triple stack method is that it allows you to diversify your investments while maintaining safety. You've got your emergency fund easily accessible, your short-term goals covered with 3-month fixed deposits, and your long-term goals covered with a combination of 12-month fixed deposits and T-bills. Plus, you're earning attractive interest rates along the way. If you found this video helpful, you'll definitely want to check out my next video on Trump versus the Fed 2024 to understand more about whether interest rates will go up or go down. Hit subscribe and the notification bell so you don't miss it. And if you learned something new today, smash that like button. It really helps the channel grow. If you found this video helpful, you'll definitely want to check out my next video on Trump versus the Fed 2024